Dividends can be used to create passive income in an investment portfolio or grow wealth over the long term through reinvestment. Knowing how to live off dividends may be central to your retirement planning strategy if you want to avoid running out of money while also managing investment risk. The income you generate from dividends can be a welcome supplement to Social Security benefits, a pension, or withdrawals from tax-advantaged accounts. Making the most of dividend income means knowing how to generate it and how to use it to your advantage. A financial advisor can provide invaluable advice on helping you set up a retirement investment strategy that includes dividend income. Welcome to Wise Thinking channel, and before we get going, make sure to like this video and subscribe for more money-related videos like this one. What are dividends? If you want to know how to live off dividends, it helps to know what they are first. Dividends represent a percentage of a company's profits as paid out to shareholders. In other words, this is money you receive simply for owning shares of a particular stock. Depending on the company, dividend payouts may come monthly, quarterly, semi-annually, or annually. Dividends may be paid as cash or as shares of stock. Not all stocks generate dividends for investors. For instance, a growth stock may not pay dividends if the company is reinvesting all profits in growth. And dividend stocks aren't all the same in terms of what they pay out to investors and how frequently those payouts occur. Dividend aristocrats and dividend kings, for example, represent the companies that have the longest track records for increasing dividend payouts year over year. Meanwhile, some companies that pay dividends regularly may reduce or eliminate their payout due to reduced profitability. Dividends are a form of passive income. In other words, this is income you don't have to do anything to earn. In a portfolio, dividend income is separate from interest income generated by bonds or the capital gains you may realize from selling stocks at a profit. It's also different from the passive income you may generate from owning real estate investments. Living off dividends in retirement. Living off dividends in retirement is a dream shared by many investors. But in today's environment marked by rising life expectancies, extremely low bond yields, and elevated stock market valuations relative to history, retirees face challenges on all fronts to build a stable income stream that will last a lifetime. Before zeroing in on any particular strategy or investment vehicle, retirees need to understand how much risk they are willing to tolerate in the context of their entire portfolio and the corresponding rate of return that can reasonably be achieved. While each of us will ultimately reach different conclusions and asset allocations, we are united by common desires to maintain a reasonable quality of life in retirement, sleep well at night, and not outlive our savings. Dividend investing is one way to achieve these objectives. The strategy can help preserve your capital over long periods of time and generate a growing income stream regardless of market conditions. The Wall Street Journal provided a practical example of how dividends can help fuel a healthy and sustainable retirement. The article assumed you retire with $1 million and desire $40,000 in annual inflation-adjusted retirement income. It also assumed that inflation runs at 2%, Treasury yields match the inflation rate, and stock dividends grow 3.5% per year. It goes on to state that you invest $400,000 into Treasury bonds and $600,000 into stocks that yield 3%, good for $18,000 in dividend income each year. After spending every dollar of dividends, you sell part of your bond portfolio to hit your $40,000 inflation-adjusted annual income target. After about 21 years, your bond portfolio would be fully depleted. However, over that time period, your annual dividend income might have grown by a third to reach $24,000 per year, even after accounting for inflation. Most importantly, you would still own all your stocks. If your dividend income grew by about 33% after adjusting for inflation, then it is reasonable to believe that the value of your stocks could have appreciated by a similar amount as their growing cash flow made them worth more over time, perhaps reaching close to $800,000 in value. Assuming you retired no sooner than the age of 60, you would now be in your 80s and have a healthy amount of funds left for the rest of your retirement. While your initial bond/stock mix will vary based on the size of your nest egg, your risk tolerance, and your return objectives, building a portfolio of several dozen quality dividend stocks that collectively yield 3% or higher and grow their dividends by at least 3.5% per year is very attainable. In fact, even in today's market environment characterized by historically low interest rates, we believe it is reasonable to construct a conservative dividend portfolio that yields between 4% and 4.5% without sacrificing on business quality, income safety, or portfolio diversification. Regardless, as the Wall Street Journal's example showed, building a growing stream of dividends can help offset today's low bond yields while avoiding some of the problems caused by potentially inflated stock prices. Let's take a closer look at the benefits and risks of leaning on dividend income in retirement. Living off dividends. The benefits of dividend-paying companies. There's nothing necessarily magical about dividends. As an asset class, we would expect dividend stocks to deliver long-term total returns that are not all that different than the returns of the broader market. The key difference is that more of the return comes from income rather than price appreciation. This can reduce volatility and make it psychologically easier for retirees to stay the course during times of turbulence. If your dividend income stream remains intact and you can make ends meet without needing to touch principal, there's some comfort in knowing you are unlikely to outlive your savings or face major setbacks if the market's performance is poor, particularly during the crucial early years of retirement. Simply put, depending on companies that pay safe and growing dividends for retirement income alleviates many of the worries that come with the ups and downs of the market. Focusing on growing dividend income rather than the noise caused by volatile stock prices fits well with a long-term investment strategy and removes some of the emotional risk associated with investing, such as panic selling during downturns. While a portfolio of dividend growth stocks will experience some variability in market value like any other equity-focused strategy, the income that a quality portfolio churns out should consistently grow over time. Many investors enjoy the simplicity of this approach compared to a systematic withdrawal system for retirement income. Which situation sounds more stressful? The investor who lives off cash flow produced and distributed by his investments each month, or the investor who must estimate a safe withdrawal rate in a variety of market conditions, and then select which assets to sell to generate enough cash flow each year? Living on dividend income in retirement can make it easier to stick to a plan by providing passive cash flow without incurring the stress of figuring out which assets to sell and when, especially if another market crash is around the corner. The focus can remain on locating safe dividend payments rather than getting concerned with the market's price volatility and how that might impact your withdrawal amounts in down years. As long as there is no reduction to the dividend, passive income keeps rolling and regardless of how the market is behaving. Johnson & Johnson, a diversified healthcare giant, provides a great example of the strategy's appeal. The chart below shows that over the past 2 decades J&J's stock price, blue line, has experienced plenty of volatility despite the firm's reputation as a defensive stalwart. Shares of Johnson & Johnson during the 2007-09 financial crisis plunged 40%, and they fell 30% during the 2020 pandemic. But the company's fundamentals remained supportive of its dividend, orange bars, providing income investors with steadily growing paychecks every year.